Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trading to bring you the market recap video for Friday, April 15th, tax day, everybody. Hope everybody got through tax season without too much scarring and too much personal drama and whatnot. So welcome out to Tackle Trading's market recap video, kind of recapping the week that was. And it's been an interesting week. There's absolutely no doubt about it. I mean, bad economics, bad fundamentals, bad earnings misses. And the market just does not want to slow down. There's no denying it at this point that the market doesn't want to slow down. And as you can see, the last 6 week rally we've seen is just really it's quite astonishing, quite amazing. We thought it would slow down right as it got into this level at 2000. We predicted it would come into that level. The next one was to come back into this level right around 2050 to 2060. Got into that level, started slowing its momentum a little bit for about a week and a half, and then broke out earlier this week. And what it was really kind of led by was financials, led by JP Morgan and such, and financials really led this market. Financials and energy, oil specifically, kind of leads the market right now. But in looking at that, quite surprising actually, because when you look at the earnings season so far is going to be one of the worst we've had since the end of the Great Recession in 2009. Earnings are going to fall flat at a negative 10% growth. Earnings are missing left and right, and yet nothing stops the market that the Fed says they will support. And that's good for right now, and that's good for the short term, and that's good for 401ks right now, and that's good for stock owners right now, and quite frankly, that's good for me right now. I mean, I own stock. My stocks are doing fantastic over the last 5-6 weeks. What it's not good for is understanding what's going to drive this market in the future, because the Fed, who has promised to support the market over the last 6 weeks, in every speech they've said this, and every speech they give, I die a little bit more, because what they don't understand is they can't prop it up forever. They can't manipulate it forever. All they're doing is making the problem worse in the future and making it more painful in the future and making it drop even further in the future. What is that future? Is it later on this year? Is it next year? Who knows? The market cycle should have been coming into 2016, and we really kind of saw that start in 2015 here and early 2016 right here. And so we did see the beginnings of it, right, based on the average market cycle of right around 7 to 8 years from top to top and bottom to bottom. And but the market's behaving a little bit differently now that the Fed has promised to support this. So the question that I've been getting, and I'm certainly will be getting it in the foreseeable future, is why in the world? Who's buying here? Like who in the world is buying this price action after this overextended rally? Who is the insane person that is out there buying off horrific economic data? I mean, if you look at the economy just this week alone, we had misses in import prices. We had misses in core retail sales, PPI, retail sales. We had misses in CPI, core CPI. We had misses in we had misses in capacity utilization. We had misses in industrial production. We had misses in consumer sentiment, which dropped to 89.7. So basically, there was not one moment this week where we had good economic data. Not one. And there's some major reports there. Retail sales, CPI reports, PPI reports, consumer sentiment reports. Not one of them beat the expectation, and the market didn't care. Not one of them. Earnings season is going to be the worst earnings season in close to 8 years since the end of 08, coming into 09, 7 to 8 years. And you were seeing abysmal misses from a financial perspective, but it doesn't matter. Nothing's going to stop this market. as long as the Fed supports it until the Fed pulls the carpet under, pulls the tablecloth outside, and basically everything comes crashing down. With that said, who's the buyers here? Because despite all of this, despite the economic data, despite the fundamental data, despite the market breaking out of resistance, despite everything I've just said, who's buying? Because I don't know a lot of hedge funds buying. I don't know a lot of institutions buying. I know a lot of people have cash on the side ready to short. I know there's a 15% higher short interest rate on the S&P 500 right now than is normal. I know put to call ratios are inverted with puts leading the charge. I know that most people who understand the financial markets, they believe this market is going down, and so they're covering risk. I know the bigwigs of the hedge fund industry, the bigwigs of the professional traders, the people who control billions and billions and billions and billions of dollars are buying put options to protect their investments. So who's buying? Well, number one, you have people that are called short traders. And the short traders have basically had increased their percentage on shorting stocks in the S&P 500, in the Dow, and the Nasdaq, and out there in the marketplace as a whole. They had increased their short positions tremendously coming into February of this year. And so when the market double bottomed in mid to the later part of February, started going back out, broke out of resistance in early part of March, as the market went up and up and up, the risk that the short traders were carrying was exceedingly high. And as it went up and up and up and up, they had to start buying back the shares that they had sold. And so it's not actually people buying stock that's leading the charge. It's short traders covering their short orders. So that's number one. Number two is you have the algorithms out there that don't care about anything around fundamentals or economics. You have the algorithms out there that if it ever breaks out of resistance or support or triggers above 2,000 or any of the support resistance zones that we've talked about in the market over the course of every day in the last 6 weeks, the algorithms are going to buy or the algorithms are going to sell. So that's the algorithms, and they don't take into account fundamentals or economics and or earnings for that matter. And then you have stock buyback programs, and that's really the catalyst here, guys. You have record numbers of stock buyback programs that are keeping the market propped up. So you have you have stocks rebuying their own shares, you have algorithms, you have short traders covering their short positions, and you have the Fed, the Central Bank of the United States, the FOMC, promising to support the market in every capacity. Where does it all stop? That's the question that is on a lot of people's minds. And quite frankly, I don't think anybody knows. I don't think the central bank knows. I don't think Wall Street knows. I don't think the government knows. I don't think corporate America knows. And I certainly don't know where the insanity stops. I do know this. At no point in human history has this type of manipulation underwent a free market that ended, positively. I've known historical examples that literally killed financial markets based on what these entities at the central bank are doing to our financial markets. So in looking at this, how do we use that information? Number one, I still own stock. I'm not dumping stock because of what might happen. I've always said that you can't cash flow on something that you don't own. I own stock. I sell it out every month. I lower my cost. If your stocks ever break support, so let's take, for example, a stock I own in First Solar, so FSLR. First Solar right here, I'm an owner in First Solar. I'm looking at it on a weekly chart, and as you can see, it came right into this very big resistance level here. Well, if it can't break that very nice resistance level here, then you need to add insurance to it. And as you can see, it's dropped from $72 down to $60 in about a 4-week stretch, and I expect that to continue. And if I look at it on the daily chart, you can see a very important support level right around $60. You have all the resistance, support, and it's at there too. You had to close at 59.59 today. If I see another downward tick in price coming on Monday, I'm going to buy insurance to protect the technicals and to protect the earnings. And so if you start to see this type of price movement happen in your stocks, it's okay to stay in it if you have the insurance to protect against both the earnings risk here as well as the technical risk to the downside here. And so there's certainly things like that we're doing. Let's take some others here that I'm looking at. So for example, we have GameStop here. If GameStop breaks 32 and a half, it doesn't matter what else anybody thinks out there. That is a technical setup to buy. Okay, if GameStop ever breaks 29, which is a clear support level, then you add the insurance if you're an investor into it. Let's look at Netflix. Everybody loves Netflix. Netflix just broke out of resistance right here, a clear buy signal. Yeah, whether or not you think Netflix is overvalued with the P ratio or not, doesn't change the fact that after this huge drop to start the year, Netflix has rallied from $80 up to 111 and just broke out of another resistance level at 106, with the next resistance level not till up into this range right around 118 to 119 with the overhead resistance right into 130. Nobody would be surprised if Netflix got into that range. So, in terms of looking at this, yes, the economics can be confusing. Why is the market going up with ridiculously bad economic data? Why is the market going up with horrific earnings so far? The worst since later part of '08, early part of '09. Why is the market going up in this? It doesn't matter. What matters is it's going somewhere. We have to trust the data in terms of our eyes, the technical data, not the economic data, not that. And as long as we see these technicals hold, especially coming into the S&P 500 itself, as long as we see as long as we see that break out, we got to be a buyer above that level. Okay, if it comes back underneath that level, maybe we switch our bias. I still have a slightly bullish bias in the marketplace from a short-term perspective. I have a neutral bias from a longer-term perspective. That neutral bias will not be broken from a weekly standpoint unless we get up above these levels here. That trend line's one thing. You have overhead resistance at 2100 and 2135 as well, which is major levels of resistance as well. Let's look at a couple other things here. The dollar index rallied into a retracement, confirmation coming back down. I did talk about this in the Wednesday recap as well as the Monday recap. My expectation is still to the negative on the dollar index. Retracements do occur, and then they start going back down. And what is really kind of interesting is the double top we're seeing here on crude. Is this an opportunity to buy insurance if you own USO? Maybe. That's something that you as an individual have to determine. But this double top of 42 is very important. Okay, what is very concerning for oil is the fact that it double topped and the dollar came down today, and so did oil. So in terms of looking at the market being overextended, if the dollar goes down and oil goes down, that's a little concerning for me. I do own oil. I own the shares of USO and I own call options on USO. I'm locking in gains on this as we speak. In the same light, dollar index, I do see the dollar index still have some weaknesses in it as well. Looking at your commodities, looking at silver, I got silver as a major buy above $16. I talked about that multiple times, and as anybody who has ever seen me give a presentation in the last year knows that I like silver, and it's starting to break out of resistance here. I like it even more into that capacity. Now, earnings last week was abysmal. There's no denying it in my estimation from an actual numbers perspective. Yeah, they beat expectations that were so ungodly awful to begin with that they should be in jail for just trying to lie and cheat the system in the first place. But outside of that, they were abysmal. And, but there was only a few stocks last week that reported earnings. We're going to go over to FinViz real quick, hit the screener button, and we're going to look at some big stocks here, the large cap stocks. And we're going to look at next week from an earnings perspective to kind of give a taste of what's coming in next week. There's 124 large cap stocks and above. reporting earnings. If you looked at this week on those, you had 17. This week is nothing compared to next week. Next week is when earnings really kind of hit the stage with technical companies, healthcare companies. Just on this first page alone, American Airlines, Abbott Labs, Alaska Air Group, Alexian, Amgen, TD Ameritrade, Amazon, Biogen. There's your pharmas out there reporting. Caterpillars of the world. You also have D.R. Horton, Fifth Third Bank Corp. Got some more banks next week as well. Coming into next week, you also have the alphabet. You have Google coming in, Hanesbrand, Hasbro, General Electric, General Motors, Intuitive Surgical, Intel Corporation, IBM, you name it. Massive week. So expect volatility. Expect randomness in the market a little bit next week, and expect the unexpected with earnings. So this is Matt Justice for Tackle Train, bringing you a market recap video for the week of, the day of Friday, April 15th, tax day. Good luck with your taxes. Good luck with your trading. Changing lives one trade at a time. TackleTrading.com.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.